Welcome back, investors. Jake here. If you've subscribed to my channel for my coverage of the war in Ukraine, there will be an update video tomorrow. This video is for my longer-term subscribers who originally followed me for my finance and investing content. We'll check in with my active trading accounts with Charles Schwab in this video, and let's talk about US stock market news. And the S&P 500 yet again was green this week, up 2.86%. And I think this is remarkable, and we just need to zoom out and look at the one-year performance of the S&P 500 index. And it's only down 4.2%. So congratulations to all of you out there who are buy and hold long-term dollar cost index fund investors. Because with all the uncertainty in the world, to only be down 4.2% over the last 365, that's pretty good. Now, the Nasdaq is a bit more choppy. For the week, it was up 2.3%, and the one-year performance, not as good, still down 10.42%. But over the last 2 months, the Nasdaq is actually now in a definition of a bull market. From its local low on June 16th to today, it is up 21%. That's the definition of a bull market. Let's now check in on Twitter with everyone's favorite perma-bear. This is the big short guy, Michael Burry. And he says, Nasdaq a bull market because it is up 20% off its low. Who makes this stuff up? After the dot-com crash in 2000, the Nasdaq did this 7 times as it continued to fall 78% to its 2002 low. So sure enough, here's the stock chart. He provides it, and there's a local low to a rebound of 20%, and this occurred 1, 2, 3, 4, 5, 6, 7 times. It is fun to go on Yahoo Finance and just look for myself. The Nasdaq peaked on March 10th, 2000, and then struggled for the next 2 years. Selling off, rebounding, resulting in maybe a 20% increase from a local low, just to sell off again, keep drawing down, keep selling off, keep falling. We're now in 2001, keep falling, and the Nasdaq eventually bottomed out on October 9th, 2002. So this was the day to buy Apple, Amazon, and Microsoft. You'd be the greatest investor of all time if you actually did that. And Michael Burry, of course, is implying that this 20% rally we're seeing in the Nasdaq today is not going to hold and that a bigger drop is potentially coming. So why is Wall Street so optimistic this summer about the economy and the market? And this is going to sound paradoxical, but CPI inflation came in for the month of July at 8.5%, and Wall Street interpreted that as good news. The reason why is because the CPI inflation number for the month prior was 9.1. 8.5 is less than 9.1. Good news, buy into the market. Potentially the next piece of good news that was even better is that the month-over-month inflation was flat. It was 0.3%. So year-over-year, it's still very high, 8.5, but more than likely, we're past the worst of it as far as inflationary increases. And this mostly has to do with the price of energy, as this is baked into the cost of almost everything. And the price of crude oil peaked on June 7th at $122 a barrel. 2 months later, it has dramatically fallen, once again as global supply has been slightly increased, but more so global demand has increased from central banks around the world raising interest rates. This is prior to the Ukraine war on February 24th. The price of oil is now back to where it was prior to Russia invading Ukraine. And the insanity of the stock market, I liked this tweet. Inflation is 8.5%, and people on Wall Street are already talking rate cuts. They're already pricing in future rate cuts, and maybe interest rates can go back down to 0%. Unfortunately, when you look at history, I think the last decade for the U.S. stock market with extremely low interest rates, these days might be behind us, as this was a once-in-a-generational mix of cheap commodities coming out of Russia, cheap labor being provided by China. Those two global inputs might be deteriorating, and the world economy might just be stuck with slower growth and higher inflation going into the future. But Wall Street this month wants to be optimistic about all this, and they're already trying to anticipate when is the Fed going to start lowering interest rates again. Now, the federal funds rate is currently between 2.25 and 2.5%. I still think future rate increases are coming. The Fed is going to meet 3 more times for the rest of the year, but the rate increases might only be 50 basis points or 25 basis points. I think before this is all over, interest rates will probably hit between 4 and 5% before the Fed will hold them, waiting for year-over-year inflation to be back under 2%. It's only at that point that the Fed can start talking about lowering interest rates. But the Nasdaq is in a bull market, so of course, finance YouTubers are going to say the market has just flipped. Now, after the Nasdaq has already gone up 20%, now it's the time to start buying. I can't advise you guys. I've never been advising you in my videos. I've demonstrated to you, I've documented all my trades. I obviously cannot predict the future. And another confusing data point for investors that is causing a lot of confusion is that payroll jobs increased by 500,000 in the month of July. In any other time, in any other day, for any other administration, this would be extremely good news. But you can argue that this is contributing to labor costs. The fact that the economy is still net adding jobs, this isn't going to actually help inflation. Unfortunately, we probably need this to be flat, low, or even losing jobs in order to have proof that inflation is finally under control. And here's the chart that is just really confusing everyone, because unemployment is at historic lows, 3.5%. The economy is basically at full employment. And to have a recession, unemployment needs to go up. When you look at the dot-com crash and the 2001 recession, we were in the recession for 6 months as unemployment was rising, the economy and the GDP was contracting. Eventually, unemployment peaks and then it starts going down again. Same is true for the 2008 recession. Unemployment was going up while we were, experiencing that 6 months of measured time. And then eventually it goes back down. But we've been in a technical recession by definition the last 6 months, and we're still lowering unemployment. We're still net adding jobs to the economy. A possible explanation that I found that I think is pretty credible is that labor force participation is dropping, which is causing these labor constraints and labor inflation in the market. And the reason why is because the baby boomers are retiring. These are people on this chart. This is a population pyramid to show demographics. And baby boomers are between the ages of 60 and 75 right now. You can see there's a small bulge here. And this was the largest generation of Americans ever to be born. They've dominated politics and the economy their entire lives. We then see the next generation, which is the Gen Xers between the ages of 40 and 55-ish, and it's a smaller cohort. There's fewer of them to be working in the economy. The demographics then bulge again as we see millennials between the ages of 25 and 35, 40. These are the children of the baby boomers. So what is happening, I think, is that the baby boomers are retiring at very large numbers, and this is drawing down labor force participation, causing inflation from a lack of workers. Companies have to pay more money to hold on to their employees or find employees. Here's the charts on the Federal Reserve's website for labor force participation. It was in the mid-50s prior to women joining the workforce, basically. More and more American households became dual income households, and labor force participation peaked in 2000s at around 67%, and it's just been falling. It's just been falling for 22 years, and labor force participation is currently at 62%, well below where it was prior to the COVID pandemic, as lots of people who have been contributing to their 401ks, IRAs, pensions, whatever, they're just cashing out. If they're saying, I can live with less, if I don't need to work, I don't want to work, and I'm just going to cash out of the markets and live out my golden years. Here's another interesting metric. This is M1. This is the Federal Reserve's best guess of how much money is in circulation. And this is in billions of dollars. So 20,000 billion is $20 trillion. And you can see that in response to the COVID pandemic, the federal government and the Fed took extraordinary measures to increase the amount of money in circulation. This helps with liquidity. This prevented a global depression, a global catastrophe. I am very much in support and in favor of what the Fed did to prevent, we'll just go back to the unemployment chart. Prevent this. Prevent 15, 20, 30% unemployment in America. However, we hit peak money. We hit peak money on March 2022, and the money supply is contracting as central banks around the world have increased their interest rates and are more than likely going to hold them for at least another year. The next chart that is perplexing is that of the US 10-year Treasury Yields, and it's currently at 2.8%. What does this mean? It means if you want to buy US debt, US government bonds, you can earn a 2.8% yield on your money every year for 10 years. And at this point, I was really expecting this yield to be higher if the Federal Reserve has stopped quantitative easing. If the Federal Reserve has stopped buying U.S. Treasury debt with money out of nothing, then the yield should be increasing to entice bond investors to buy U.S. debt. And you could see that it did momentarily spike to 3.5%, but it's back down to 2.8%. And I don't have any data to back this up, but my speculation is that there's a lot of serious money, large money around the world buying U.S. Treasuries for safety and security. So if you're a government or a billionaire in Europe or a government and billionaire in Asia, and you're worried about an economic recession on your continent, then you might turn to U.S. Treasuries for the safety and security on your money. The saying is that you only need to get rich once. At that point, all you have to do is preserve your money to, combat inflation as all money becomes less valuable over time. So if you were to buy $1 billion worth of U.S. treasuries, you'd be guaranteeing yourself $28 million a year for 10 years. For a billionaire or a government, that's good enough for them. Yes, inflation is high right now at 8.5%, but what is it going to be a year from now or 2 years from now? There are lots of wealthy individuals that see this 2.8% and they say good enough, especially if the economies in Europe and Asia are going to be in decline. That's my only explanation for why the US Treasury yield hasn't gone higher, hasn't gone to 3 or 4%. If it was just Americans buying it, I think it would be spiking much higher to entice investors, but I think there's a lot of serious money around the globe fleeing to U.S. Treasury debt for the safety and security. Let's go on Finviz.com and look at the heat map. This is let's go to the 1 week performance, and pretty decent week for a lot of these companies. But when we zoom out to the 1 month, you're seeing the trend over the last month or so. Apple up 15%, Microsoft up 14%, Amazon up 29%, Tesla up 25%. The only sector, I can't explain it, in the red is healthcare. And we need to talk about Apple because Apple from its low is up over 30%. So let's look at the charts here, and the QQQ from its low, it's up that 21%. But Apple from its low on June 16th is actually up 32. So Apple is the largest component of the S&P 500 index. It's the largest component in the Nasdaq. So if Apple over the last 2 months is up 32%, that means the Nasdaq index minus Apple is only up 18 or 19%. Apple is dragging up the Nasdaq by overperforming. Let's now go on TradingView and I'll show you the charts. And from a technical standpoint, as a technical trader, none of this makes any sense to me. We were locked in this downtrend for 6 months. I was charting it. I then literally bet everything that the trend would hold and continue, and I perfectly mistimed it. So with technical analysis, you're always looking for something different, and this is definitely something different as the S&P continues to rise and go up. When we switch to the Nasdaq, it's the same thing, just a little bit more steep. I have to believe that at some point in the next couple weeks, as the market is overbought, there will be a slight sell-off, and maybe we'll go back to this uptrend line. The intermediate uptrend is still intact, but the market is just so overbought at the moment. And what's terrifying to me is that it's overbought on very low volumes of trade. It's not like huge funds are dumping all of their cash into the market. The market is more or less just drifting up on very low trade. What happens when we have another day or another week where lots of investors get involved and there's a higher amount of trading activity occurring? Let's now look at the stock chart for Apple, and no other stock in the mega caps looks like this. Microsoft doesn't look like this, Google, Amazon, Tesla, Nvidia. Only Apple has gone straight up uninterrupted for 5, 6, 7 weeks straight. And what's fascinating is we're now on a collision course for Apple's all-time highs, $180 a share. If Apple can get back above where it was on January 4th when the entire market peaked, let's try to understand it. And to understand it, let's look at their valuations. Let's go on macrotrends.net and let's look at Apple's price to earnings ratio. Currently 27.8, and 27.8 is almost double the historic average P to E valuation for the entire market. For a premium brand, for a great company, yes, you can pay a higher premium. Apple pays a dividend. Apple does stock buybacks. They reward their investors with profits from their company. Let's look at Apple's price to sales ratio. Lower is better. And you can see Apple's historic price to sales was always in this 2 to 4 range, and it's currently 7.2. Okay, if a company is experiencing rapid growth, it's okay to pay for a higher price to sales multiple. Rapidly growing companies have higher price to sales ratios. So let's look at Apple's revenue growth based on their last earnings report, their last quarter. You can pay a price to sales for 7 for a rapidly growing company. And when we look at the most recent quarter for Apple, they grew their revenue year over year by only 1.8%. Make this make sense to me. I challenge you because I just don't get it. And I think the year over year comparison for the third quarter from last year to this year for Apple is going to be worse. I just think it's a difficult comparison because 2021 with easy money and stimulus and all that stuff, it was just a very good year for these companies. Or perhaps I'm missing something and there's something in the news that is causing Apple to rocket up. And here's a report on Seeking Alpha that Apple could raise their iPhone 14 average selling price by as much as 15%. That's good news for the company. If they announce the iPhone 14 with a 15% cost increase, this is their #1 selling product, and all the Apple users who are going to buy an iPhone 14 are going to buy it anyways, even though it's 15% more expensive. This is fantastic news for Apple's revenue. But what if, Europe is in recession, Asia's in recession, the United States labor market is still good, but technically we're also in a recession. What if people just say, I'm going to hold on to my iPhone 13, my iPhone 12, my iPhone 11. I'm just going to hold on to it for one more year. Could be devastating for Apple. I just can't predict. I just can't justify. Nothing about this makes sense, guys. Next piece of news is that Apple could announce a mixed reality headset in January. The announcement in January for a product launch probably in the fall. And the price of the headset could be $2,500. I don't know who's in charge of developing this product and pricing it, but that doesn't seem competitive when the Meta Oculus Quest headset is only $400. Maybe Meta will release a higher-end version, closer to $1,000, but $2,500, I just don't know how many people, aside from the most die-hard Apple loyalists, are going to pay that price for a mixed reality headset. Next piece of news that's interesting is after Foxconn reported their earnings, they warned of slowing smartphone demand. Foxconn is a partner and manufacturer for Apple, and they're seeing weakening, especially in Asia, but this could be a broader trend for Apple. Apple, same website, same week, article with conflicting information. Apple reportedly tells iPhone partners to crank up production plans for their iPhone 14 launch this fall. So Apple still thinks that they have a superior product that's going to be in high demand, and they're going to sell a record number of iPhone 14s this fall. I can't predict the future, guys. I have no clue what's going to happen. So let's now check in with my active trading accounts. This is my Schwab account. Originally started a year and a half ago with $25,000, and the last 7 months have been an absolute disaster for me. I'm not going to hide this from you. People keep asking in the comments section, am I still holding on to all of my put contracts? And yes, I am. This is not a screenshot. I am still holding all of these in my Schwab accounts, 21 put contracts that I fear will, in 1 month's time, when they expire on September 16th, I'm pretty confident all of these are going to expire worthless. I don't think the Nasdaq is going to sell off or drift down back below a strike of 300. There always could be some catastrophic news, some escalation, some global catastrophe that could panic the markets, but that's not investing. That's praying. So my strategy over the next month is to hope for or wait for potentially the VIX to spike. Options contracts are greatly affected by volatility, and it doesn't take a lot to get the VIX to spike. So as the VIX has gone down over the last 2 months, as the market has been very calm, this has greatly affected options prices. And if there can be a momentary sell-off, the VIX will spike back up to this $34, $35 range. It's done this 4 times since last November. And if I can get a spike on the volatility, I'll probably sell to close all of my contracts for whatever money I can draw from them and just accept my losses and figure out on my tax returns this year how to claim capital losses that will have to be eventually carried over to the next tax year. Final piece of housekeeping to take care of in this video is an existential crisis of what exactly is my YouTube channel now. If you've made it this far in the video, you're a true supporter. I greatly appreciate you. And let me just share with you some of the analytics inside my YouTube channel and what's been happening recently. So on August 4th, I uploaded this video, Russia just got terrible news. And in a little over a week, I've gotten 678,000 views on this video. This video has the potential to be my first video on my channel to get over 1 million views. And none of my finance and investing content can even compete with videos that I've put out about the Russia-Ukraine crisis. And it has completely changed the demographics of my channel over the last 5 or 6 months, as I've gained over 100,000 subscribers, and most of them are international. So here is the performance of my YouTube channel over the last 28 days by geography. And only 36% of my audience now is American. 11% is United Kingdom, 7% is Canada, 6% Australia, 3.5% Germany, 3% Sweden. But look at the demographics of my channel by geography for last year, 2021, prior to the invasion of Ukraine by Russia, and 85% of my audience was American last year. So to talk about credit cards and IRAs and 401ks, which is all United States-based, tax code law, to talk about the U.S. stock market when 85% of my audience is American, this makes sense. But to talk about the U.S. stock market when only 36% of my audience now is American, this is a problem. And I can show you with the performance of my channel the last couple weeks exactly what is happening. So when I post a video about the Russia-Ukraine war, for example, this video 3 weeks ago got 264,000 views. I then post an update video on my active trading account talking about the US stock market. This video only gets 27,000 views. And me a year ago, 27,000 views would have been fantastic. I would have been happy every day of the week getting 27,000 views. But the next video that I put out talking about the Russia-Ukraine war only got 156,000 views. The reason why is the way the YouTube algorithm works is everybody who watched this video, gave it a thumbs up, commented, whatever, the algorithm then shows them my next video, even though it's completely unrelated and not interesting to them. So my click-through rate for a video like this might be 11, 12, 13%. The click-through rate for this video then is like 3 or 4% because 70% of my audience is not American and they're just not going to click on this video and watch it. I wouldn't expect them to. So because they didn't watch this video, when I upload my next video about the Russia-Ukraine war, there's not as many recommends or pushes being given by YouTube because my audience didn't click on the last video. This is frustrating and unfortunate because it makes it hard for a YouTube channel to have diversified content. It's still possible, but it has to be personality or character driven. Whether, a YouTuber one day is talking about cars, the next day is talking about cooking, the next day they're gardening. If you love that person, you'll just click on and watch every video, even though you're not interested in that topic. But to be a successful current events geopolitical commentary channel, my videos need to be related, congruent, in order to help the algorithm keep stacking it. So this video got 156,000 views. My next update video did better. It got 174 as people who watched this one were recommended this one. It then went up again, 279,000 views because people who watched this one were recommended this one. I then uploaded my next video 2 weeks ago talking about my Schwab account. Got 55,000 views, which is fantastic. But my next Ukraine update video, 162,000 views. There was a drop because there was a break in viewership from this video to this video because I sandwiched in between a video that was completely unrelated. The same thing happened. People who watched this video were recommended this one. I got an increase of 162 to 278. I then had the next successive video, got recommended, went up crazy to 678,000. So what is my plan? My Schwab accounts, I'm either going to cash out what I can or it's going to zero over the next month. I've been saving a lot of cash. I haven't made any deposits in my accounts pretty much the entire year. And I'm going to reset my Schwab accounts and finally become a value investor. just buy and hold forever, dollar cost average in. And I'm going to launch a new channel, a second channel, and I just might call it, Trading with Jake or Trader Bro or, some kind of clever name. I'll make an announcement video when I do that, but my main channel now I think is a current events and geopolitics channel. My bachelor's is in legal studies and political science. My master's is in international relations. I have 6 years experience as an active duty Air Force officer, so I can continue adding value to the YouTube community by making these kinds of videos, and I think financially, that's what I need to focus on now. So that's my thoughts. I'll be explaining this again, explaining this more in future videos. If you made it this far, you're an all-star. I greatly appreciate you. You've done enough. You don't need to do any more for me. I'm incredibly grateful from the success I've made on YouTube, as my channel is going to hit 200,000 subscribers either next week or the week after. Absolutely mind-blowing. I couldn't be any more grateful for all the success that I've had. That's all for this update video. If you guys want to leave me a comment, I always love to read them. I'll try and respond to as many as I can on this video. I can't respond to all the messages and comments I get anymore. There's thousands a day. Till the next video, take care, be safe.